Today we are going to discuss our quarter two market outlook and also, look backwards at quarter one. We're doing this a little bit early just given the recent market volatility. We're not going to get into politics, but we are going to talk about how this will affect your portfolio and what moves we are making proactively to address any volatility in the market and what we see moving forward as the best positions, obviously staying in the market at all times. We came into 2025 with a risk-on stance in our portfolio, reflecting an optimistic view of the strength of the overall U.S. economy and a better than consensus outlook on the trajectory of corporate earnings. So in this trade, we remain risk-on, maintaining a clear preference for stocks over bonds, though we are modestly recalibrating the magnitude of this view by reducing our equity overweight from 4% to 3%. So just as an example, this means if you're an 80-20 investor, 80% equities, 20% fixed income, back in November, we were 84-16, and now we are going to be 83% equities, 17% fixed income, just using 80-20 as an example. So this reflects an acknowledgement that markets have moved a bit closer to pricing in our above consensus forecast. However, within equities, we're increasing our overweight in the U.S. Historically, we've been 2/3 U.S. So for example, in a 100% stock portfolio, 0% fixed income, traditionally you would be 2/3 in the U.S., 1/3 international. Now that's calibrated to about 78% U.S., 22% international. We're emphasizing exposure to large, high-quality U.S. companies with relative earnings strengths while fading the recent developed market rallies or regional forward earnings guidance calls. International earnings signals have softened, and in our view, the European economy remains meaningfully behind in AI infrastructure build-out and will likely continue to face challenging geopolitical issues in 2025. We are also reducing our overweight to Chinese equities, mitigating exposure to potential positive surprises from tariff negotiations and aggressive Chinese government stimulus. So we're going to find, we have a very cool slide that shows, essentially what the parity line between the U.S. and other nations are. And surprisingly, China is actually a little bit left of the parity line, meaning our current setup with China is favorable to the U.S. Now, there's a lot of political backed, we think is negotiations, that are happening, still threatening China with these tariffs. But we do view that, given the underperformance of China in the last couple of years, we're lessening our complete avoidance of Chinese markets moving forward. In an effort to improve overall portfolio diversification, we are adding further to scarce assets. So in this trade, we have increased our gold allocation by another 1%, funding from fixed income. So gold has delivered very strong results since our November 2024 rebalance, and we see further upside catalysts from potential global trade disruption, geopolitical conflict. Finally, with fixed income, we are shortening duration positioning within the U.S. Treasuries, expecting to capture similar term premiums and yields, but with less volatility by moving away from ultra-long bonds. Over the past few months, markets have been on quite the roller coaster ride, driven by a series of headline and grabbing events. Following the presidential victory of Trump in November, there was a huge surge in the market returns. Investors welcomed his pro-business agenda, which included corporate tax rate cuts, deregulation. However, the initial excitement of the Trump trade began to wane as the Federal Reserve's hawkish stance of future rate cuts led to another market pullback in December. As we moved into January and February, volatility persisted, fueled by a series of market-moving events. We were hit with an AI-related sell-off as DeepSeek, a Chinese AI lab, released an LLM that raised concerns over AI hardware spending and U.S. AI dominance. More recently, we've experienced significantly uncertainty over Trump's tariff policy and inflation. Despite the barrage of headline events, the markets have shown remarkable resilience. S&P 500 has risen by 3.5% since November. As of February 25th of 2025, this resilience is important to highlight because we believe these topics will continue to drive volatility moving forward. As a team, we are very focused on the health of the economy, consumer and corporate fundamentals as the long-term drivers of the markets. The U.S. economy appears strong on many measures. However, unemployment has inched up but remains low at 4.1%, with the labor market averaging 186,000 new jobs per month in 2024. Consumers are showing resilience, and a tightened housing market is contributing to historically high home equity values and related wealth effect. This uptick in headline sensitivity certainly deserves attention, which underpins our decision to make a slight trim to our overweight in the equity positions while still maintaining a strategic overweight to risk assets. Shifting our attention to earnings, we spend a lot of time analyzing and talking about forward-looking earnings expectations. which is a big driver of our tactical positioning in our portfolios. And the good news is that earnings growth forecasts in the U.S. stocks continue to be very strong. We are seeing, however, a bit of broadening out finally taking place. The Mag 7 now comprise a third of the U.S. equity market, has dominated both headlines and returns for the past 2 years. Will this cohort continue to outperform in 2024, helping drive positions alpha as tech continues to be one of our large overweights in the portfolios? We're starting to see the market breadth expand. And as shown in this graph in Q3, year-on-year results, earning results specifically for the Mag 7 dwarf results of the S&P 500 without tech, over 22% versus 6%. However, further looking at the data of Q4, we still see that the very strong double-digit earnings growth in tech, we're seeing that gap narrow meaningfully with the S&P 500 excluding tech coming in at 12.3% now. So as a result, we are reducing our long-held underweight to value stocks, as well as looking to incorporate some thematic ideas where appropriate in a world that we think requires a bit more granularity. All of that said, we still expect the Mag 7 to lead earnings growth, and this continues to be our favored position in the U.S. equity market. We have similar conviction in the broad mega cap stocks and quality stocks. However, as their relative growth advantage declines, we see the opportunity for equity outperformance emerging beyond these mega cap names to perhaps come more of a balance overall. As investors have grown accustomed to robust earnings, market reactions to positive surprises are starting to fade. This desensitization has led to a progressively muted response in stock performance following earnings beats. Over the past 5 years, we tend to see stocks move higher by about 1%, 2 days before the earnings release through 2 days after. Companies beating expectations Q4 actually see an average price increase of 0.5% in the same period. It's also worth noting, as it's not fully captured in this chart, but many of the earnings beats we saw in Q2 and Q3 were coming from technology and communication names, where earnings beats were massive. So some of this Q4 data can be explained as the market is becoming less impressed with beats, but it's also worth noting that the magnitude of beats isn't as large today as it was a few quarters ago. At the same time, companies missing expectations are facing heightened scrutiny. 5-year average has moved from 1.8% negative to 2.3% negative for companies missing expectations in that same 2-day window. And as you can see in the chart, we are seeing these trends play out just over days, but now weeks. Equally striking is the observation that for companies not beating expectations, not only are they being punished early on, but we're not seeing that same snapback observed in the prior quarters looking at the rightmost chart. This further supports the notion that staying invested in the parts of the market that are continuing to deliver earnings and earnings beats has become increasingly more important. In addition, 2025 earnings expectations have steadily revised downward. While such adjustments are common, investors typically wait for actual results before reacting. However, with the S&P 500 trading at 22x forward earnings, further downward revisions could weigh on sentiment and dampen market confidence. We actually view these lowered estimates as a potential positive as they reset expectations and reduce the hurdle for outperformance. Negative sentiment surrounding revisions reinforces our buy the dip approach, in particular when we have a strong foundation of growth and Federal Reserve that remains on hold, underpinning the market. Consensus today is 2.3% real GDP, and so while the scope for broad economic expansion is not as hot as it was last year, we want to continue to lean in the portion of the market driving earnings per share higher. Market overreactions often create compelling entry points, and with strong fundamentals still supporting long-term growth, these disconnects can offer attractive investment opportunities. Our preference for U.S. equities over developed markets challenge two prevailing narratives: that leading U.S. tech stocks are an overcrowded trade, and that developed market international stocks offer contrarian value. The outperformance of the Magnificent Seven, specifically in recent years, coupled with rising tech exposure in the major indices and AI-driven enthusiasm, has fueled the belief that tech is widely owned across portfolios, suggesting that outperformance may now lie in contrarian positioning. Looking at the chart on the left, we analyze all active fund managers' holdings through their 13F filings found on the SEC website. You can see that somewhat counterintuitively, active managers actually remain underweight most of the Mag 7 and broader large cap tech, and by a wide margin. This positioning has weighed on the performance of many of our competitors, which has struggled as a result. This is a pain trade that they wish to resolve, and so we see this as being somewhat of a favorable setup for tech names. The idea that international developed market stocks are under-owned is also misleading. Survey data suggests that developed market equities have become a consensus long trade, contradicting the notion that they represent an overlooked opportunity. When intentional international stocks outperformed U.S. equities earlier in the year, driven by improved earnings and a pause in U.S. dollar strength, we believe this relative momentum could fade. Recall that in November, we added to developed markets to take a more neutral posture, as that time we were seeing a slight improving earnings picture, which has allowed us to participate on this recent rally. However, International developed market earnings signals have weakened, and Europe remains significantly behind. Really, in AI infrastructure development will continue to grapple with geopolitical challenges heading into 2025. So we believe it's a good time to fade this trade. Moving to the policy landscape, we've seen that President Trump has begun to move quickly and aggressively in many regards, seen through his appointments, his relatively large number of executive orders, and his desire to reduce government waste, etc. On February 13th, he issued a memorandum directing several U.S. agencies to come up with plans for specific tariffs, following the spirit of how he directly said on social media that whatever countries charge the United States, we will charge them no more, no less. As we demonstrate here on the slide, there is actually significant dispersion in this regard. It should be noted that measuring tariffs on an apples-to-apples basis is complicated and can come up with results that vary widely. Here we show analysis from the Wolf Research pulling data from the World Trade Organization, which incorporates most favored nation rates. In the White House memo, the ask was not only on tariffs, but also on VATs, digital service taxes, etc., given a potential broad view of reciprocity and leading to even more uncertainty. We see two takeaways. First, we observe that this reciprocity on tariffs only should result in just moderate tariffs in most cases, especially as many of our key trading partners like Canada and Mexico are covered by free trade agreements. Second, a lot has been made in the news about policies we may place on China. What's interesting to observe is that China already exists above the reciprocity line, which means it's favorable for the U.S. That is to say, we already have much higher tariffs in place compared to what they impose on the U.S. exports, creating possibility that tariffs could be less significant than originally anticipated. Within the portfolio, and specifically our emerging market equities, we do think there is a growing risk of remaining underweight to China. We have seen the Chinese central government enact a number of stimulative measures, and we do not think there is a risk to the upside for China. Also note where our other significant emerging market players like Brazil and China exist on this chart. While our long-term views remain intact that there are several long-term strategic challenges in place for China, and we are looking to take some risk out of the anti-China bet and adding to broad emerging market exposures alongside our emerging market, excluding China exposure, because we have an ETF that specifically excludes China. Ultimately, when it comes to this policy, it's quite hard to predict exactly what will be put into place or even what the president has authority to enact. As it stands today, these various government agencies have just been asked to provide analysis by April 1st, after which then Commerce, the United States Trade Representative, can investigate what policies to pursue. As always, we'll continue to watch closely and adjust portfolios as needed. And one thing that's interesting about this chart is that Canada and Mexico, as you can see, are right on the reciprocity line, and China, again, in the upper left-hand corner of the page, already favorable. This has been a big, huge risk to a lot of corporations in the U.S. that do a lot of imports from China. This may not be as bad as originally anticipated. As to be expected, corporates are keenly focused on what may transpire here, as tariff has become a boardroom buzzword again, with mentions on earnings calls exceeding Trump 1.0 era levels. While the impact is yet to be understood, tariff increases could impact corporate margins and disrupt spending plans at least moderately. Looking at the yellow line, which is represented by the Bloom & Davis Economic and Policy Uncertainty Index, we also see a huge uptick here in the recent weeks. Sentiment regarding tariffs has become excessively bearish, so in line with one of our key points from the prior slide, we don't think it's a stretch to say that the pain trade for any surprise could actually be to the upside with fewer changes than feared. While there are significant unknowns here, looking at these charts, we would argue that much of this uncertainty has been baked into the market already, and given the fundamental and economic picture we painted, we don't see this as a time to significantly de-risk. In November, we highlighted our growing interest in the scarce asset theme as a means to help hedge a potential loss in purchasing power, and we expressed this through an addition to gold. That trade has been very additive to start the year, with the precious metal up 8% through February of 2025. From the time of add versus the Bloomberg U.S. Aggregate Bond Index up 1% and the S&P 500 relatively flat. A core thesis for us comes back to the idea that we have seen a significant uptick in both institutional demand as well as international central banks buying gold. Notably, we see central banks in China and Russia looking for a way to diversify their reserves from the dollar. In an increasingly hostile geopolitical landscape, we don't see this trend slowing down. Nearly 70% of global gold mine output continues to be purchased by central banks, creating an attractive tailwind in the demand picture. Further, we do think that gold provides strong diversification properties. Gold carries a beta to long treasuries of about 0.7. And so when funding from fixed income, we're not entirely getting away from fixed income risk characteristics. As a strategic holding, however, we see some of those protective features that we've earned from treasuries historically. We also see more upside in the near term. With the run in the equity markets in 2023 and 2024, market participants may fear that they've missed the boat and that entry points are no longer attractive. When examining historical data, we see the 3-year annualized returns are lagging long-term returns, so currently trending at the bottom 25th percentile since 1957. Additionally, looking through all bull markets going back to 1926, the average length spans 55 months, for which we are only about halfway through. We do not see a repeat of 2022 bear market on the horizon, which was driven by surging inflation, unprecedented Federal Reserve rate hikes, and geopolitical instability following Russia's invasion of Ukraine. Today, we are no longer impacted by massive unwind from the COVID resulting in excessive inflation. We have a Fed that is still on pause and an economic picture remains favorably overall. While the pace of recent gains over the last 2 years feel rapid, taking a longer perspective, returns remain below historical averages. And with no immediate concern for recession on the horizon, we believe there remains plenty of room to run with a positive outlooks for stocks moving forward. So historically, the returns of 3-year averages have been about 10%. And right now our 3-year averages, 2022, 23, 2024, is about 8.5%. So if wondering, now time to fund in the market or make adjustments out, stay the course. And if you have cash on the sidelines, definitely dollar cost average in. We recommend on a weekly basis over the next 3 to 6 months. So bring it all together. 3 major themes here. We're trimming our equity overweight from 4% to 3%. We're increasing our preference for the US over our international space, and we're hedging exposures to geopolitical risks. Any questions, as always, please reach out. We look forward to reviewing. And as always, a good financial plan can get you through a tough time. And having the fail-safes that we've always discussed with our clients will ensure that you can live your life by design. Regardless if we're in a 2022, when both stocks and bonds are dropping, want to make sure that you're able to live your life, go on vacations, spend the money that you were expecting to spend if you're in retirement, without worrying about headlines, without worrying about any market volatility. If you're a client of EWA, you have a financial plan that supports those goals no matter what. But please reach out with any questions, and we look forward to discussing further.